Good day and welcome back to the Business Career College video series. In this video, we're going to spend a few minutes looking at non-refundable tax credits. These are a staple of our tax system. This is something that really pretty much everybody doing any sort of financial services training has to be at least somewhat aware of. Every personal taxpayer gets some of these non-refundable tax credits. Now, we're just going to do a quick look at the difference between a deduction and a credit. So a deduction works from basically your top dollar of income down. So if you have somebody who, for example, is earning, let's say, $100,000 a year, that person is at the 36% federal tax bracket. And if that person had a $10,000 deduction from income, that would come from the top down. So a $10,000 deduction for this person at their, sorry, I said 36% federal tax bracket. That should be 26%. I'm in Alberta and it's a combined 26%. So that's 26% federal, sorry, or 36% provincial. We'll use just federal tax bracket. So at $10,000 at a 26% federal tax bracket, this person gets $2,600 in savings on their federal taxes, plus whatever their provincial marginal tax rate is. And there aren't actually that many things that represent deductions. The RSP contribution is the biggest one that most people will be familiar with. Business expenses are another deduction, childcare expenses, and if you happen to leverage in a non-registered account, the interest on, let's say, an investment loan, as long as it's non-registered and there's an expectation of profit and so forth, then you can deduct that. And I don't want to get into all of those rules here. That's a separate issue. So it's not that many things. And I always sort of quantify a deduction, or qualify, I suppose, a deduction as sort of a spend money to make money item. So if you kind of justify it this way, you got to spend money to make money, then you're probably in deduction territory. Whereas a credit's a little bit different. Credits in general are designed to incentivize or encourage a behavior. And credits don't do the same thing. Credits actually only apply, for the most part, at the bottom tax bracket. It doesn't matter what tax bracket you're in. Now, there are some exceptions to that. There are 4 exceptions. And those exceptions relate to specific activities. The exceptions you'd want to know here, possibly, are charitable contributions. And even that's only true on charitable contributions over $200. Again, that's a matter for a separate video. Foreign investment tax credit is a little bit of a weird credit. It does some different things. Dividend tax credits are credited at different rates. Donations to a political party. So those credits are all offered at different rates. That's really not the point of this video. I want to cover off the more sort of plain vanilla credits. So what happens with your tax credit? It's at that lowest rate no matter what. So the lowest federal rate is 15%. That's simple, just a nice low 15% tax rate. And it doesn't matter then if you have credits that give you enough tax savings to push you into a second tax bracket or whatever the case is. It's just 15%. and then you can add the lowest rate for your province. So I've got a little chart here that shows the lowest rate by province. You could just add that in. So for example, if you have a taxpayer in Saskatchewan, Saskatchewan has a low rate of 10.75%. A Saskatchewan taxpayer with a $1,000 tax credit would save 15% on their federal taxes and 10.75% provincial taxes. They would have a combined tax savings then of $150 over here and $107.50 over here. So their combined tax savings for that $1,000 tax credit would be $257.50. And you can see that it doesn't matter what tax bracket that person is at. So there are lots of tax credits. There's actually a long, long list of tax credits. The most common tax credit, the one that everybody gets, is the basic amount. The basic personal exemption, or the basic amount, or the basic credit, whatever we're going to call it. And as of 2017, this amount is $11,635. Most tax credits are indexed to inflation. So there's a fixed measure in the Income Tax Act in Section 117 of the Income Tax Act that says a tax credit bumps up by whatever the consumer price index number is each year. So you'll see a different basic amount in 2018, and there was a different one again in 2016, and so forth. Not every province gives that same basic amount. The provinces pick and choose the rates at which they want to offer these credits. So again, to our Saskatchewan example, a Saskatchewan taxpayer actually has a $16,065 basic amount, so a little higher than the federal amount. Whereas if you were in, let's say, Ontario, your basic amount in Ontario is a little lower at $10,171. So that's the most common tax credit, and that tax credit has all kinds of implications. For example, if you have a taxpayer who makes less than that $10,171, and that person happens to be married, they can actually transfer some of that credit over to their spouse if they weren't using the whole amount. So lots and lots of tax credits here. Taxtips.ca has a really good list of tax credits. You have credits like the disability amount, you have credits like the caregiver credit, medical expenses, which will be covered in a separate video, all your related tuition and education amounts. So lots of different tax credits. I hope that helps. I hope that gets you a good understanding of what a non-refundable tax credit is. Oh, and I should mention, the reason we call it non-refundable is simply because it can't reduce your tax bill to less than zero. So if you, for example, had a taxpayer who would have, maybe this person just has a $500 tax bill and $600 of non-refundable credits, basically that person has $100 of wasted credits. And with that $100 of wasted credits, it's just gone. There are some credits you can carry forward. There's tuition and charitable donations and medical that can be carried forward, but you really have to manage those properly. There is another set of credits called refundable credits, which is a much smaller group of credits, and those would actually result in the taxpayer getting a check when they qualify for those tax credits. The best known of those would be the GST credit. Again, we'll cover those in a separate video. So I hope that's helpful. I hope that gets you a good understanding of non-refundable tax credits, and enjoy your continued studies.